you've been watching the headlines over the last few days, it probably feels like silver has suddenly become everyone's favorite metal again. You've seen the thumbnails: silver breakout imminent, silver about to explode, silver is the trade of the decade, and if you're holding silver already or thinking about holding it, you're probably asking a simpler, quieter question. Do the next few days actually matter, or is this just another round of noise? That's what I want to unpack today, calmly, without hype, without assuming the financial system is about to collapse by Friday, and without pretending that one candle on a chart changes everything. This is Financial Briefing. The goal here has always been clarity over excitement, process, over prediction, and context over conviction. Silver is a market that rewards patience and punishes emotional decision-making, and the next few days really do matter, but probably not for the reasons some of the louder voices online are suggesting. Before we dig into the data, I want to do something that most channels don't bother with, and that's accountability. Not because I'm always right, I'm not, but because this market humbles everyone eventually, and pretending otherwise doesn't help you make better decisions. Back in early March, when silver was trading around $24 and change, we said the odds favored a move toward 26 before any sustained pullback. That played out over the following 5 weeks, with silver topping just above 26.50 before rolling over. That wasn't perfect timing, but the direction and magnitude were within range. In late April, when silver surged through $28 and sentiment flipped aggressively bullish almost overnight, we cautioned that the move was stretched short term. The call wasn't that silver was done, but that a consolidation between 27 and 29 was more likely than an immediate push to 35. Over the next month, silver chopped sideways, frustrating both bulls and bears. That was a neutral outcome, but it mattered for positioning. More recently, in early June, we said that if silver could hold above 29.50 on a weekly closing basis, the probability of a test to the low 30s increased meaningfully. That level held, and silver pushed into the 31 to 32 range. Again, not a victory lap, just a reminder that this channel tracks outcomes, not just narratives. So with silver now trading roughly between $30 and $33, depending on the session, the question becomes less about whether silver is bullish or bearish in some absolute sense, and more about what the data says about timing, risk, and probability over the next several days. Let's start with the first data point that actually matters right now, and that's spot price behavior relative to recent volatility. Silver is currently trading near $32 per ounce, give or take. Over the last 30 trading sessions, the average true range has expanded to roughly 80 to 90 cents per day. That's elevated compared to the first quarter of the year, when daily ranges were close, to 40 to 50 cents. Historically, when silver's daily range nearly doubles over a short period, it signals transition, not resolution. What that means is that the market is deciding something, but it hasn't decided yet. In past cycles, similar volatility expansions have occurred near inflection points, both before major breakouts and before sharp reversals. In 2011, volatility expanded aggressively before silver went parabolic and then collapsed. In 2020, volatility expanded before silver broke out sustainably from the high teens into the mid-20s. What it means is that the next few daily closes matter more than usual because volatility is no longer compressing, it's expanding. Markets don't stay in that state for long. What it doesn't mean is that volatility guarantees a breakout higher. Increased volatility is not directional. It's a condition, not a conclusion. Some channels are treating wide candles as proof that silver is being let loose. In reality, wide candles simply mean disagreement between buyers and sellers is increasing. The second data point is futures open interest. As of the most recent reporting, COMEX silver open interest has risen to approximately 155,000 contracts. That's up from around 135,000 contracts just 6 weeks ago. Historically, that's a meaningful increase, but it's not extreme. For context, during the 2020 breakout, open interest surged above 200,000 contracts. During the 2011 peak, it exceeded 230,000. So what does this tell us? It tells us participation is increasing. More players are getting involved. Liquidity is rising. That's generally constructive for trend development. But here's the nuance. Rising open interest alongside rising prices usually means new longs are entering the market. That can fuel a trend until it doesn't. If price stalls while open interest continues to rise, it often precedes a shakeout. Weak hands enter late and strong hands distribute. What it means is that the next few days matter because they will tell us whether price can absorb this new participation without breaking down. What it doesn't mean is that banks are trapped or that there is an imminent default. Those narratives resurface every cycle, and while structural issues in the silver market do exist, they don't resolve on a Tuesday afternoon because open interest ticks higher. The third data point is short-term momentum relative to longer-term trend. Silver's 50-day moving average is currently near $29. The 200-day moving average is closer to 26, Price at 32 is roughly 10% above the 50-day and over 20% above the 200-day. That's stretched, but not unprecedented. Historically, silver has spent about 70% of its time within plus or minus 8% of its 50-day average. When it exceeds that range, mean reversion risk increases. But mean reversion doesn't mean collapse. It often means consolidation. What this tells us is that upside from here is possible, but not free. Momentum traders are in control in the short term, while longer-term allocators are watching carefully, not chasing aggressively. What it doesn't tell us is that silver is overbought in a way that forces an immediate decline. Overbought conditions can persist for weeks in strong trends. They just raise the cost of being wrong. So taking these three data points together, expanded volatility, rising open interest, and stretched short-term momentum, the picture that emerges is one of tension. Not euphoria, not panic, tension. And that brings us naturally into the bull case, because there is a credible one, and it deserves to be stated clearly without exaggeration. The first bullish factor is that silver is breaking out of a multi-year range on a nominal basis. Prices above $30 were rare between 2013 and 2023. Sustained trade above that level signals a regime change, at least in nominal terms. Second, inflation-adjusted real rates remain historically low. Even with higher nominal yields, inflation expectations keep real yields compressed. Silver has historically performed better when real yields are not strongly positive. Third, industrial demand continues to grow, particularly from solar and electrification. Unlike some previous cycles, silver demand is not purely monetary or speculative. That adds a layer of structural support. Fourth, investor allocation to precious metals remains modest. Despite the headlines, silver is not a crowded trade in institutional portfolios. Most large funds remain underweight. Put together, the bullish scenario is that silver consolidates briefly and then pushes toward the mid-30s, potentially testing $35 over the next 1 to 3 months. I would assign that outcome a probability of roughly 25%. Not impossible, not dominant, but meaningful enough to respect. Now, the bear case deserves equal attention because ignoring it is how people get trapped. First, silver has a long history of false breakouts. Moves above key psychological levels often attract momentum buyers who exit quickly when price stalls. Second, the US dollar, while not surging, has stabilized. A renewed dollar bid would pressure silver, especially if risk assets wobble. Third, speculative positioning is rising faster than physical demand signals. That imbalance can correct sharply. Fourth, macro uncertainty cuts both ways. Slowing growth can support precious metals, but it can also reduce industrial demand expectations. In the bearish scenario, silver fails to hold above 30, pulls back toward 28 or even 27, shakes out weak longs, and resets sentiment. I'd put that probability around 30%. Which brings us to the middle case, the one that rarely gets clicks but most often plays out. The most likely scenario in my view is consolidation. Silver oscillates between roughly $30 and $33 over the next several weeks. Volatility remains elevated, sentiment cools, and the market digests gains. This allows moving averages to catch up, speculative excess to ease, and the next directional move to form from a more stable base. I'd assign that outcome a probability of about 45%. Before we talk about action plans, it's important to place this moment in historical context. In late 2010, silver broke above $20 after years of resistance. The initial breakout was choppy. There were sharp pullbacks. Many investors were shaken out before the eventual run to nearly 50. The similarity is the breakout from long-term resistance. The difference is that monetary conditions today are tighter and speculative fervor is far lower. In 2020, silver broke out from $18 to $21 quickly, then consolidated before continuing higher. That cycle was fueled by massive liquidity injections. Today's environment is more constrained, so history rhymes, but it doesn't repeat cleanly. Cross-market signals add nuance. Gold has been holding near record highs, around $2,300. That's supportive, but gold is not accelerating. The dollar index is range-bound, not collapsing. The 10-year yield is elevated but stable. Together, that suggests a neutral to supportive backdrop, not a runaway environment. Positioning data shows that commercial hedgers have increased short exposure modestly, while managed money has increased longs. That's normal at this stage, not extreme, but something to monitor. So what am I doing personally? I'm holding a silver allocation of roughly 10% of my portfolio. Of that, about 60% is physical, 40% is liquid exposure. I'm not adding aggressively here. If silver pulls back toward 29, I add incrementally. If silver breaks and holds above 34, I reassess. My stop loss on trading positions sits near 28.50. My take profit on partial positions is around 36. Not advice, just my framework. What I'm not doing is panic buying. I'm not watching fear-driven content, and I'm not assuming that silver needs to save the financial system to justify its price. This week, I'm watching three things closely. First, daily closes relative to $30. Second, open interest behavior during up and down days. Third, gold's ability to hold recent highs. If silver holds 30 on down days, that's bullish. If it breaks below with volume, caution increases. To wrap this up, here's the summary. Silver is at an inflection point, not a finish line. The data supports volatility, not certainty. The next few days matter because they shape positioning, not because they guarantee outcomes. And patience remains the most underrated strategy in this market. Now, I want to slow this down a bit and spend more time inside the data, because this is where most of the signal lives, and where most of the hype tends to fall apart. One of the reasons the next few days matter so much for silver is because of where we are in the short-term calendar. We're coming out of a period where positioning has shifted quickly, but confirmation hasn't arrived yet. That gap between positioning and confirmation is where mistakes usually happen. Let's go deeper into the volatility point, because it's easy to underestimate what it's telling us. When silver's average daily range expands the way it has, from roughly 50 cents earlier this year to nearly $1 now, it usually means that liquidity is being tested. Buyers are more aggressive, sellers are more reactive, and stops are getting triggered on both sides. In past cycles, this kind of expansion tends to cluster around decision points rather than trend continuations. If you go back to 2016, when silver moved from $14 to $21, the most violent daily ranges didn't happen at the start of the move. They happened right before consolidation phases. The same thing occurred in mid-2020 and again in early 2021. So what does that mean right now? It means that if you're holding silver, you should expect noise. Big intraday swings are not evidence that the market is out of control. They're evidence that participants are recalibrating risk. What it does not mean is that every red candle is manipulation, or that every green candle confirms a moonshot. Volatility is uncomfortable, and discomfort tends to breed narratives. But the market doesn't care about our narratives. The second data point I want to expand on is futures curve structure, because this is something that rarely gets discussed outside professional circles. Right now, the silver futures curve is relatively flat. Front-month contracts are not trading at a large premium or discount to later months. That tells us two things. First, there's no immediate supply panic. Second, there's no strong incentive to roll aggressively in either direction. In periods of genuine physical stress, you tend to see backwardation, where near-term contracts trade above longer-dated ones. We're not seeing that in a sustained way. Spot tightness exists in pockets, but it's not systemic. What that means is that the market is not screaming shortage. It's signaling balance with tension. What it doesn't mean is that physical silver is irrelevant or that long-term supply issues don't exist. Those are slower moving forces, but they don't resolve in the next few days, which is why I'm skeptical of headlines claiming imminent structural failure. The third data point here is volume distribution. Over the last 2 weeks, volume has been heaviest on up days, but not overwhelmingly so. Down days have also seen meaningful participation. That tells us that this is not one-sided enthusiasm. There's real disagreement. In strong breakout phases, volume tends to cluster heavily on upside continuation days. In topping phases, volume spikes on reversals. Right now, we're somewhere in between. That ambiguity is exactly why timing matters. If volume starts expanding on higher, closes above 33, that shifts probabilities. If volume expands on breakdowns below 30, that does the opposite. So let's talk more carefully about the bullish scenario, because even though I assigned it a 25% probability, that's not trivial. The strongest bullish argument is structural rather than technical. Silver supply growth has been constrained for years due to underinvestment in mining. At the same time, industrial demand has become less cyclical and more policy-driven. Solar capacity targets aren't optional in many regions, they're mandated. That doesn't guarantee price appreciation in the short term, but it raises the floor over the medium term. Another bullish factor is gold's behavior. Gold is not acting like a speculative asset right now, it's acting like a reserve asset. Central bank buying remains elevated, and that tends to support the precious metals complex as a whole. A third bullish factor is that retail participation in silver, while louder online, is not extreme in actual capital terms. The dollar amounts involved are still modest compared to previous peaks. That leaves room for incremental demand without immediate saturation. And finally, silver often lags gold in the early phases of precious metal cycles, then accelerates later. If gold continues to hold near highs, silver has a history of playing catch-up. But now let's balance that with the bear case, because this is where discipline matters most. One of the most overlooked bearish risks is complacency about downside speed. Silver doesn't drift lower, it snaps. When support breaks, it tends to break quickly. Another risk is macro repricing. If economic data surprises to the upside and pushes yields higher, silver could struggle even if inflation remains sticky. The market trades relative expectations, not absolutes. A third risk is that industrial demand assumptions are forward-looking. If growth expectations weaken, demand projections can be revised lower quickly, even if current consumption remains strong. And finally, sentiment cycles in silver are short. Optimism can flip to frustration in a matter of weeks if price stalls. That's when marginal buyers disappear. So again, we're left with a range of plausible outcomes, none of which justify certainty. That's why the middle case deserves emphasis. In my base case, silver continues to trade choppily between 30 and 33. We see false breaks in both directions. Social media sentiment oscillates wildly, but the underlying structure improves quietly. This kind of action is boring for traders and healthy for longer-term holders. Now let's zoom out and look at historical context more carefully, because this helps anchor expectations. In early 2004, silver broke above $6 after nearly a decade of stagnation. The breakout didn't lead to immediate fireworks. Instead, silver consolidated, frustrated early bulls, and then began a multi-year advance. The similarity today is the long base. The difference is the macro environment. In 2004, globalization was expanding and debt levels were lower. Today, we're dealing with higher leverage and tighter policy constraints. That doesn't negate the bull case, but it tempers it. In 2011, silver's final surge was driven by speculative leverage and retail frenzy. Today's market lacks that intensity. That's a positive from a stability perspective, but it also means moves may be slower and less dramatic. Cross-market signals reinforce this moderation. Gold holding above 2,200 is supportive, but not euphoric. The dollar index hovering near 104 is restrictive, but not crushing. The 10-year yield near 4% is elevated, but no longer rising aggressively. This combination tends to produce range-bound behavior in silver, rather than runaway trends. Positioning data adds another layer. Commercial hedgers. Increasing shorts doesn't automatically mean a top. It means they're doing their job, locking in prices. Managed money adding longs doesn't mean a bubble. It means momentum is being expressed. The danger comes when both sides become extreme. We're not there yet. So again, the next few days matter not because they'll decide silver's fate for the next decade, but because they'll shape short-term psychology and positioning. That brings us naturally into the practical question: how to act without overreacting. But before we go there, I want to be very clear about what I am and am not optimizing for. I'm not trying to catch the exact high or low. I'm trying to avoid large errors. I'm trying to stay solvent, patient, and flexible. That mindset matters more than any indicator. In the next part, I'll walk through my action framework in more detail, including specific if-then scenarios, what I'm watching this week, and what I'm deliberately not doing, even if the headlines get louder. That's where most people go wrong, and it's where discipline actually shows up. Let's move into the part of the discussion that actually changes outcomes, because understanding the data is one thing, but translating that understanding into behavior is where most investors either add value or quietly give it back. When I think about silver here, I'm not asking, is silver bullish? That's too blunt a question. I'm asking, what conditions would change my behavior and what conditions would not? That distinction matters, especially in a market that's emotionally charged and headline-driven. So here's how I'm framing it. First, let's talk about positioning context in more detail, because this is where short-term risk often hides. Commitment of traders. Data shows that managed money long positions have increased meaningfully over the past month. Not explosively, but meaningfully. Commercial hedgers, miners, refiners, large physical participants have added shorts at higher prices. That's normal. It doesn't mean they know something the rest of us don't. It means they're responding to higher prices by locking in margins. What matters is the balance. Managed money net longs are elevated relative to the last year, but still well below extremes seen in 2011 or even 2020. That suggests there is still room for speculative interest to grow, but also room for it to retreat without breaking the market. Institutional behavior more broadly remains cautious. Large diversified funds are not overweight silver. Precious metals allocations, where they exist, still lean heavily toward gold. Silver remains the secondary exposure, not the core. That tells me this is not a crowded trade in the way social media would have you believe. Now let's translate all of that into an actual action plan, not a prediction, an operating framework. Here's how I'm handling it. If silver holds above $30 on a closing basis over the next several sessions, even with volatility, I remain patient. I do nothing. Holding above that level tells me that buyers are willing to defend it, and that the market is comfortable digesting gains rather than rejecting them. If silver breaks below 30 briefly, but reclaims it quickly within a day or two, that's noise. I still do nothing. False breaks happen frequently in silver, especially during volatile phases. If silver breaks below 30 and then fails to reclaim it within 3 to 5 trading days, that's information. In that scenario, I reduce trading exposure modestly, not because the long-term thesis is broken, but because short-term momentum would have turned against the position. If silver pulls back toward the 28.50 to 29 zone and stabilizes there, I add incrementally, not aggressively, incrementally. That zone aligns with the rising 50-day moving average and prior consolidation. It's where risk-reward improves. On the upside, if silver breaks above 34 and holds it on strong volume, that tells me something different. That would suggest the market is willing to accept higher prices without immediate profit taking. In that scenario, I reassess position size and trailing stops, rather than chasing with fresh capital. Right now, my silver exposure sits at roughly 10% of my overall portfolio. Of that 10%, about 6% is physical silver, held with no intention of trading, and about 4% is liquid exposure that I manage more actively. My stop loss on the actively managed portion is around 28.50. That level is not magic. It's simply where the structure would change enough that I'd want to step aside and wait. My first take-profit zone on a portion of that trading exposure is around $36. Again, not because 36 is the top, but because it represents a level where risk-reward shifts and trimming make sense. Everything beyond that is conditional. And just to be very clear, this is not advice. It's not a recommendation. It's just my framework, shared, so you can see how I'm thinking, not so you can copy it. Now, just as important as what I'm doing is what I'm deliberately not doing. First, I'm not panic buying. I don't buy silver because a chart looks exciting or because someone says, last chance. If I missed a move, I missed it. There will always be another setup. Second, I'm not watching fear-based or hype-based content to guide my decisions. That includes both extremes. The collapse narratives and the get-rich-quick narratives both distort judgment. Third, I'm not assuming that silver needs a crisis to justify its price. Silver can move higher in a slow, uneven way driven by supply constraints and steady demand. It doesn't require drama to work. This mindset matters because silver has a unique way of punishing emotional behavior. It rallies just enough to trigger fear of missing out, then pulls back just enough to trigger regret. The investors who do best are the ones who refuse to play that emotional game. Now let's talk about what I'm watching very closely over the next several days, because this is where the title of this video really comes into focus. The first thing on my watch list is daily closing behavior around $30. Not intraday spikes, not wick extremes, closing prices. If silver continues to close above 30 despite volatility, that's constructive. If it starts closing below and staying there, that's cautionary. The second thing I'm watching is volume relative to direction. I want to see whether higher prices are being confirmed by expanding volume, or whether rallies are happening on thinning participation. The former supports continuation. The latter often precedes reversals. The third thing I'm watching is gold's behavior relative to silver. If gold holds steady or grinds higher while silver weakens, that's a warning sign. If gold holds steady and silver holds its gains, that's confirmation. Silver rarely leads sustainably on its own. Secondary to that, I'm watching the dollar index and the 10-year yield, but more for confirmation than signals. A sharp move in either would matter. Range-bound behavior reinforces the base case. All of this brings us back to the core message. Yes, the next few days matter if you're holding silver, but not because they'll decide whether silver goes to 50 or back to 15. They matter because they'll tell us whether this market is transitioning into a higher range or whether it needs more time to digest. Most mistakes happen when investors confuse urgency with importance. Silver rewards patience more often than prediction. In the final part, I'll pull this all together with a clean summary, revisit the probabilities one last time, and close with the broader takeaway for long-term holders versus short-term traders. Let's bring this all together because by this point you've heard a lot of numbers, a lot of context, and a lot of nuance, and the value only shows up if it resolves into something coherent. Silver right now is not a story about certainty, it's a story about balance. On one side, you have real structural support, years of underinvestment in supply, growing industrial demand that's tied to long-term energy and electrification policy rather than short-term consumer cycles. A monetary backdrop where trust in fiat systems isn't collapsing, but isn't strengthening either. On the other side, you have very real short-term risks, a price that's stretched above key moving averages, rising speculative participation, a macro environment that's restrictive enough to punish excess, even if it hasn't broken anything yet. That's why I've been careful throughout this entire discussion. To separate probability from possibility, the bullish scenario is possible. Silver could consolidate briefly, then move higher into the mid-30s, maybe even test 35 or 36 over the next couple of months. That scenario is supported by supply constraints, supportive gold behavior, and the fact that silver is still under-owned institutionally. But it's not the dominant outcome. I keep that probability around 25%. The bearish scenario is also possible. Silver could fail to hold 30, slide back into the high 20s, frustrate late buyers, and reset sentiment. That would not invalidate the long-term case, but it would punish anyone who assumed the move had to continue immediately. I put that probability around 30%. The middle case, the one that doesn't sell thumbnails, is what I think is most likely. Choppy, volatile consolidation between roughly $30 and $33. Time passing, expectations cooling, structure improving quietly. That's where I place the highest probability, around 45%. And that's why the next few days matter. Not because they decide silver's destiny, but because they influence behavior. They influence whether traders press risk or reduce it, whether narratives escalate or fade, whether patience is rewarded or tested. If you're a long-term holder of physical silver, the honest truth is that the next few days matter less for your outcome than your discipline. Your biggest risk isn't a pullback, it's emotional decision-making during volatility. If you're a shorter-term participant, the next few days matter more, but only if you define in advance what matters to you: levels, time frames, risk limits. Without those, volatility becomes noise instead of information. So let me leave you with a clean, simple summary. Silver is above a major long-term level, but not in a confirmed runaway trend. Volatility is elevated because the market is deciding, not because it's breaking. The bull case is real, but not dominant. The bear case is real, but not fatal. And the most likely outcome is patience being tested before direction becomes clearer. That's not exciting, but it's honest. If you value this kind of grounded, probability-based analysis, without hype, without fear, and without pretending certainty exists where it doesn't, consider subscribing to the channel. This is Financial Briefing.